So today we're live with Teresa Bailey and David Waddell of Waddell Associates. I'm going to tell you a little bit about their background and their roles, and then we'll get things started. As the firm's chief investment officer, David Waddell chairs the WNA Investment Committee and combines macroeconomic forecasting, macro market analysis, and macro risk assessments. Do you have to say that every time you introduce yourself?
I should.
To design portfolio strategies using public market securities across the globe. He's a civic leader in Memphis, acting as the chairman of Epicenter Memphis and co-chair of Memphis Chamber Chairman's Circle, as well as a board member for Launch Tennessee and New Memphis Institute. David was a member of the 2004 Leadership Memphis class and has been recognized as one of Memphis's top 40 under 40 by the Memphis Business Journal, and was a finalist for Executive of the Year in 2007. So welcome, David.
Thank you.
Teresa Bailey is a wealth strategist. She orchestrates the financial affairs of executives, entrepreneurs, and other driven individuals. In addition to growing her clients' financial worlds, Teresa builds the WNA brand through coordinating brand development, client events, and educational content development. Teresa is a certified financial planner and divorce financial analyst. She was also named one of Memphis Business Journal's top 40 under 40 in 2016, and in 2018 began splitting her time between Memphis and Nashville offices of WNA. So today they're going to be talking about the cognitive and behavioral biases that often keep entrepreneurs from optimizing their net worth. You will walk away having learned how to recognize these entrepreneurial attributes and what to do once you identify them and need a change. So I'll let David and Teresa take it away and answer the $1 million question, why you aren't rich yet.
Oh, thank you, Leah. The pressure, $1 million question, why you're not rich yet. Thank you so much for having us. Today's presentation really initially was given to an audience of entrepreneurs. I know likely in the Petra audience, we do have those entrepreneurs present today, but some of the support team members, other team members in the organization, although you might not have full entrepreneur attributes, there's probably some entrepreneur in each of you. And certainly the behavioral bias discussion, it may not be the same profile of bias that applies to you specifically, but the concepts will still apply. And then when Mr. Waddell does his wonderful math for you, that certainly will still apply. So with that, another point for this presentation is, what does rich mean? So for us today, it's all about the dollars. There are many other avenues we could take for this, whether, you know, a life of fulfillment is rich. Today, it's all about the money, all about growing that balance sheet. And the way that we'll segment the presentation is the first half will be with me, and that is know thyself. Second half, we're going to roll over to David, and he is going to cover know thy balance sheet. Anything I've left off, David? Is that cover?
No, it sounds great. I'm really interested. So let's get rolling.
All right. So Leah talked a little bit about our bios. We do have this disclosure, all the legalese. We are not making specific recommendations today. Leah covered David's bio. The point that I've put up here today is that David, son of an entrepreneur, went to school for entrepreneurship, works day in and day out with business owners, and he owns our business, CEO, and also spends day in and day out in investment decision-making situations. For me specifically, corporate finance background, I've been in this industry for 15 years now. Have certified financial planner, certified divorce financial analyst, but I also began my career in a financial firm as COO. So I've been in the business making the decision. So I love working with business owners as clients, and I love digging into the know thyself and the know thy balance sheet. But because this is Petra, and it's place where we really dig into know thyself, I'll go ahead and put my other bio up that includes my DISC assessment, my Myers-Briggs, my Enneagram type, to show that I have to deal with the same thing. When I'm giving advice, I have to know thyself. Also, when I'm receiving it, because I'm a high D, I can tend to sort of blow through all of the details and try to go with my gut and make a decision. I'm pretty much any of the personality types that can seem a little challenging at times. David has to deal with that as my boss, and he can speak to that as well. I've also had all of the family events, life events, things that can sometimes, in addition to our personality types, get in our way, sort of that baggage that we talk about in making solid, appropriate decisions for ourselves. You know, my grandparents lost their pharmacy businesses even before I was born, and that had a ripple effect in our family. I've had death, my own divorce, my own failed partnership. Most recently, I developed a food allergy. So my newest emotion is hangry because the allergy is soy and I can't eat anywhere anymore. So it just goes to show I'm giving financial advice all the time. I still have to deal with all of my stuff as well. All right. So because this was for an audience of entrepreneurs, the number one reason we focused on first, and we'll talk about today, is why you're not rich yet. Number one, because you are an entrepreneur.
Hey, Teresa, before you get deep in, I'm going to remind everyone that this is an interactive session. If you have questions or you have any comments or you want anything you want to discuss, go ahead and pop that in the Q&A box or the chat box, and we'll make sure we make time for that at the end.
Yes, please ask all questions, especially for David's part of it. All right. Because you are an entrepreneur, you have many tremendous attributes that make you awesome at seeing what something can accomplish, thinking outside the box. But there's also some communication and some thinking biases that you have. You're human. And a bias is an illogical preference or prejudice. It's uniquely human. And there's a huge bucket of different biases, but there are some that happen more frequently in the entrepreneurial world. And when we talk about becoming rich, there's a blend of psychology and math, like we talked about Know Thyself and Know Thy Balance Sheet. Vanguard actually put a study together that tried to quantify all the different components of advice giving in a role like a financial advisor. Portfolio construction, wealth management, behavioral coaching. As you can see on the screen, and I'll go into more detail on the next slide, the highest one was the behavioral coaching. So in the study, they looked at that portfolio construction I mentioned. That's which investments to choose, whether they should be in a taxable investment account or a retirement account. They looked at wealth management. That's how often should you change the blend between equity and fixed income, sort of the bonds and the stocks. Also, if you need money, which account do you take it from? Those are both extremely important components of investing and your balance sheet, and the ones that get the most newsworthy attention. But what Vanguard uncovered is it's the behavioral coaching. And I've got a cute little picture of all of the emotions from a movie. But when you're sad, when you're irritated, when you're mad, you're still making decisions that affect your balance sheet. And advisor guidance in behavioral coaching, per Vanguard, can add the most potential net additional investment return, about 1.5%. All right, so what is behavioral coaching? This was the most bottom line graphic that I could find. Investment return is you set your optimal portfolio, you let it ride. That is the return that you should receive. Investor return is when you have an impact in that account. Maybe the pandemic happens and you suddenly want to go all cash, or you hear something, maybe a buddy of yours is invested in something and you want to switch the investment allocation. That investor return is when the human part of you gets involved, and there's a gap in return there. And this is from Carl Richards. He calls it the behavior gap. All right, and here's a little bit of nerd stuff about investment. Some of you may have heard about the efficient frontier. This is where David and his investment team spend their nirvana time. That curve is the efficient frontier, and the dot is the perfect blend of return for the amount of risk, the standard deviation that you take on. And if you can put a portfolio on that dot, it's amazing. What happens, though, is emotion gets factored in, right? And when we as investors get involved in our portfolio, we opt to try to make decisions, maybe take on more cash than we should, and that return drops. And I think David mentioned today an article that you read about this.
So there's an article in the Wall Street Journal today where those behavioral biases not only reduce investment returns over time, which everybody kind of knows, but they also actually increase the volatility. So what's driving people to these alternate positions than their ideal asset allocation plan is fear. And actually the fear ends up not only increasing volatility, but decreasing returns. So it's a 2x mistake, basically.
So if I compare, I think we just said move the sad guy over to the right even more.
Yeah.
Less return for more risk. Well, what our job is this, right? So maybe you can't sleep at night if the portfolio blend really does make you worry. So our job is to come in. I know David would prefer that you always be on that dot, right?
Always.
He just wants you to remove the emotion. But as a wealth strategist, part of what I do is figure out, okay, maybe we can't always be on that dot with the investments, but let's talk about a compromise where you're still getting the return for the in the portfolio with a more stable emotion around it. Entrepreneurs prefer to participate more actively in wealth creation. And when we talk about two different types today, we're going to talk about growth and aggressive, both participate actively. And many of you have heard, may have even answered a questionnaire in an investment form. What's your risk tolerance profile? Some people who are very, very conservative might believe that they're risky and vice versa. But we'll talk a little bit through some examples to try to get your head framed around what actually makes someone active or passive, growth or conservative. All right. If you have a more emotional reaction than a cognitive reaction, then that's one way to sort of place yourself on passive versus active. A growth investor, an active investor who has cognitive biases, which are thinking errors, is in that growth category. An investor who does like to participate, have a more active involvement, maybe own their own business, choose their own investments, but has a little bit more of emotional error thinking, that may make you an aggressive investor. And some actual examples, gentleman on the left, he wants to own the home, but without any mortgage balance, right? His bias might be a mental accounting bias. For him, emotionally, that house is a very safe asset. You can show data all day long that cash in an investment portfolio would generate more return than what he's spending on that mortgage. Doesn't matter. No amount of data is going to change his mind. He wants that house and he doesn't want a mortgage. The woman to his left won't make a decision about the house at all, right? You're going to have to show a lot of data to get her to move forward. Her bias might be regret aversion. She fears making an unwise decision. She needs to review the data, but once she reviews the data, she'll move forward. A gentleman to my right, he doesn't really want her house, disagrees with the appraisal. He thinks the house that he had picked out would be a better selection. His bias might be self-attribution bias. His decision is going to be the one that comes out the most successful. Everybody else doesn't know what they're doing. For him, if you show him enough data, he will eventually move forward and get on board with buying her house. Obviously, in this situation, the spouse. All right, and the woman on the far right, she wants her house and her divorce, but only if the marital dissolution agreement is signed by February. Why? Because she's going to turn around and sell that house, and the housing market is the hottest in March. And she thinks if she has control of the situation, she can get the right price for it. Her bias, illusion of control. And this one for entrepreneurs is what we run into more often than not. If I can just control that stock market, then I can generate a better return. All right, growth investors, quickly to run through: strong-willed, independent thinkers. Many of you in a business recognize this profile, may make investment decision without consulting anyone, most likely to be obsessed with beating the market, because if you look at the data, you should be able to beat the market. That's the mindset. Aggressive investors, that emotional bias, feeling errors. Often they are first generation wealth creators, even more strong-willed than the growth investors, and chase higher risk investments. These are also most often wanting to change the levers in an investment portfolio to generate higher returns, but it actually works to the detriment and erodes returns, constantly changing the investment lineup. All right, what a growth investor needs from an advisor: education. So when working with an advisor, if you're a growth investor and that profile felt like it was you, like I was speaking right to you, you need an advisor that speaks your language, that can show you data, that can answer your questions, and that you're comfortable asking questions too. Scary for you entrepreneurs out there. What you need, if you're an aggressive investor profile entrepreneur, you really need somebody to take the reins. And I know that that is terrifying. But for you, building a trusted relationship and allowing someone to coach you through and make the decisions is really what studies have shown is the most optimal outcome. All right, moving on. Why you're not rich yet, number 2. It's because you're too busy. And I'm not really sure I need any data on that. All of you who recognize this, too busy to focus on it, too busy in the business to pay attention to your personal balance sheet. You're just too busy. But if you place priority here, change will happen in a positive way. And why you're not rich yet, number 3, because you don't have a coordinated strategy implemented across all of your professional service providers. So coordinated strategy implemented across all of your providers. And I'll give you an example on that. An entrepreneur suddenly has $200,000 in cash and she needs to decide what to do with it. First call she places is to her bank. That's where the cash is sitting. And Anita offers to increase Anna's overall interest rate if she deposits the cash in a new savings program they have. And she's going to get tickets to the Preds game. We're here in Nashville, so I use Preds. All right, then she's not really sure about that. So she calls her tax preparer, Mitzi. Mitzi says, oh, we have an investment arm. How about you invest those dollars with us? She's not quite sure about that either. So she calls Matthew, her financial advisor, also an insurance guy. He advises that she really needs to start thinking about retirement and that she should do a whole life insurance policy or maybe even a variable annuity. All of these things, interesting to consider. So what will Anna do? This is her business finally cash flowing after 5 long years. Many options from service providers she trusts. What does she do? She pays off her condo. She had a mortgage for 3.5% interest. She wasn't quite sure what to do, but to her, it made sense. You were paying interest, pay it off. You don't have to pay a mortgage anymore. And again, what's wrong with that? If times get tight in her business and it stops cash flowing, she won't have that mortgage to pay. Well, really holistically, talking about a strategy implemented across all providers, none of them reviewed her current balance sheet or her life. So doing a little bit more digging, her parents are ill. They live on Social Security. She's an only child and she's had her head in the sand about it. So she doesn't necessarily have a responsibility to take care of her parents, but that cash is gone. If she decides she wants to, that cash is now in her house because her only liquidity was that $200,000. She has $10,000 in her checking account, $25,000 in her savings account. And if she wants that cash to help her parents or do something else or work in her business, she's going to have to take on debt and pull it back out of her house. And her only debt was her mortgage. And many would argue that a 3.5% rate mortgage is an asset. And why you're not rich yet, number 4, because you don't have a strategy outside of your business strategy. And so this is where the math comes in. And I'm going to stop sharing my screen and let Mr. Waddell take over. If you are ready to share yours, David.
I mean, I'll try.
All right.
All right, let me do the share screen stuff. You did an excellent job, by the way, Teresa.
Thank you, sir.
Let me see. All right, can you see that?
We can.
All right, then we are.
No, try. I think you said try. Yeah.
I did say that, didn't I? So Teresa, you've done an excellent job on know thyself. That's mission critical in leadership, in running a business, and also in trying to build wealth. So I'm going to get into know thy balance sheet in my portion. We're going to do a lot of math, and I'm going to try and get you on that dot, even if you resist being on that dot, as Teresa says you would. So here's what we're going to do. We're going to do a case study on ED entrepreneur, right? We're going to walk through what I think is kind of a fairly typical entrepreneurial balance sheet and then figure out how to optimize it if we can, and how much additional wealth that will unlock.
Hey, David.
Yeah.
Before you get deep in, we have a question on Teresa's part. Teresa, do you want to go ahead and answer that, or do you want to save it to the end?
Yeah, well, if we can voice the question, I think David's going to probably dig really deep.
I am. I saw the question. I'm going to hit it.
Okay.
Perfect. There we go.
All right. So here is Edie's balance sheet. Edie has a company that anchors her balance sheet. She's got some stocks and bonds, but really those are within her 401k. And there's sort of a default investment program there that I'll speak to. And then Edie's a fan of entrepreneurs, loves an entrepreneur, willing to put a little money in some friends' ideas. And so she's got a few startups in her portfolio that she's funded with angel financing. And then Edie has an old home that her family lived in until she had the means to upgrade to a new home, decided that, go ahead and rent that house out, especially since she loves real estate. You can control it, which is one of the biases that Teresa sort of mentioned. And they moved into their dream home. And so we'll talk a little bit about that. That's on the balance sheet. And also, entrepreneurs love cash. All entrepreneurs, no matter how brave they look to you, I is one, so I know, wake up in the middle of the night at 3 a.m. and think, what if it all just falls apart? And so entrepreneurs tend to stockpile feather beds of cash, if you will. All right, let's dig into each one of these individually and get a sense of what the expected rate of returns ought to be. All right, so let's value Eddie's company. All right, it's $1 million, and I'll get into the breakdown. She's got no debt on the company, and so it contributes $1 million to her total net worth. In terms of real estate, her new dream home that her family has just moved into, they bought for $1.5 million, and they paid $300,000 down, and they borrowed, and therefore they have a mortgage of $1.2 million. So 20% of the 1.5 is on her balance sheet. The rest is registered as debt. The previous property, they had fully paid down, used the excess cash flow out of the business. And so the $750,000 value of that property just drips right into the net worth bucket. So there's a $750,000 contribution to net worth that came from the previous home. In terms of cash, like I said, feather bed of cash may seem like a lot of cash, but I'm telling you, entrepreneurs carry a lot of cash. And so there's $750,000 sitting in sort of savings, and that goes, of course, straight to net worth. In terms of stock, again, residing within her 401k, she's got about 250 grand allocated to the stock market. No loans against her 401k. So that goes right into net worth. And then angel deals, again, things that you can touch and feel, people she likes, $200,000 of excess cash went into funding some startup businesses. And then bonds, why does she have bonds? Well, the allocation within the 401k, it was automatically allocated. She really hadn't done anything with the allocation, and it defaults to a 60% stock, 40% bond allocation. So she owns some bonds. And you add it all up, she's got 4.6 million in assets. She got 1.2 million in debt, really only the mortgage associated with her home. And you do the math on that, her net worth is $3.4 million. So this is a representative balance sheet. It may be bigger, it may be smaller than yours. It doesn't really matter. All the following principles will apply, I promise. So let's talk about the company. And this is important because for most people, for entrepreneurs at least, your company is the anchor on your balance sheet. So let's take a moment and try and figure out how to come up with an expected rate of return for Edie's company. All right, so it's 2020, or it was, and Edie's company did $2 million in revenue. She thinks that revenue will continue to scale through her work with Petra. And by 2030, it'll be a $4 million company, which is about a 7% growth rate. So she thinks 7% growth top line. In terms of the expenses, she likes to keep those at about 75% of revenues. And this is expenses before owner compensation. She'll take her own compensation up by about 5% a year, just to reward herself for the work that she does. And then there'll be distributable income with the remainder. And so in 2020, there was 200 grand in distributable income. That will grow to, nearly 500 grand by 2030, because you get some expansion in profit margins. This is a very healthy business, right? So this is a business that's growing at 7% a year. It's got basically stable profit margins and rising net profit because she's increasing her salary a little less than the growth rate of the business. It's a good business. Could you sell it? Maybe. She doesn't know, though, whether she wants to sell it inside or outside. And just for you all, keeping shorthand notes, the average multiple for an inside sale for a small business is about 4 times. The average multiple for an outside sale for a small business is about 6 times. So let's just do the average because she doesn't know what she wants to do. And so we'll ascribe a multiple of 5 for the business sale, which gives us an estimated business value today of $1 million, right? You take that distributable income, you multiply it times 5, that is your estimated business value. And it rises up to 2.5 million by 2030. And then you have to trust me on the math. Those of you who want to ask questions about the math, I'm happy to dig into spreadsheets. I'm not going to do it here. But the business rate of return over that period using those inputs is 16.6% annualized, which is pretty damn good. Way to go, Edie. All right, Edie loves real estate, can control it emotionally, can see it, can walk it, can touch it, loves real estate. Well, here's part of the reason why. Doesn't like volatility. Volatility is scary. And real estate, even though your house doesn't price every day, and if it did, like a ticker tape would on your TV, it would probably freak you out. But using the Nashville House Price Index going back to the early 80s, you can see it's basically lived within 0 to 10% with a couple of periods, the S&L crisis in 91 and the great financial crisis in 2008 of negative returns. Otherwise, positive returns, low volatility, and because the Nashville market's been so hot, she's loved the rates of return that she's reading about in the papers. So if you look at it, past 3 years, 8% annualized return, past 5 years, 8%, 10 years, 4.8%, 25 years, 4.5%. Those seem like really juicy returns. And for that reason, Edie loves real estate. However, that's just gross returns. Edie hasn't really done the math to figure out what the net returns really are on this real estate. So let's do that for her. All right, this is just going to be an example of how you calculate this kind of stuff. The annual appreciation, I'll choose the 25-year average because I think that's fair. So the 25-year average gross price appreciation, about 4.5% in Nashville. Mortgage rates today, just below 3%. In terms of annual maintenance costs, people differ on this. Some people say it's about 3% of value to maintain a property. Some say it's 2%. Depends on how many boxwood hedges you have, whatever. We're just going to go with 2%. We'll just pick an innocuous purchase price of $1 million. Monthly rental rate, call it a cap rate of 5. So let's say if you rented your $1 million house, you could get $5,000 a month for it. Annual property taxes, I actually pulled that from the web for Nashville. On a $1 million house, it'd be about $11,000 a year. And then in terms of homeowners insurance on that level of a house, it's about $4,000 a year. Rent and expense increase for the purposes of the analysis, at least the rental analysis. I'm not assuming that there's any rent and expense increase, kind of cancel each other out. Income tax rates, 35%, previous administration. Capital gains tax rates, 23.8%. Holding period, 10 years. And there is annual depreciation for tax purposes if you convert your house into a rental, which can be a benefit. So here's all the inputs to go and figure out what the actual rates of return are on a real estate investment. Oh, and lastly, when you sell it, the lovely real estate agent in the Range Rover would like their commission, as would the closing agent, the lawyer, et cetera, and that totals up typically to about 6%. So those are all the inputs to figure out what the net rate of return really is on a $1 million property. All right, if you buy your $1 million property with cash, remember you're going to get that price appreciation of 4.53%. Then you got to deduct all those expenses, and over time it equates the 10-year holding period to a return of about 1.1%. Okay, so if you pay cash, you get a 1.1% return. If you put 20% down and you don't take that balance and invest it somewhere else, but you only have the 200 on the million to put down, then the rate of return on the house would be about negative 0.2%, right? If you take out the mortgage. Now, if you use that mortgage to buy another asset class with a higher rate of return, then you're doing some balance sheet optimization. We'll get there. But for just pure math, you buy it with cash, it's 1.1, you put 20% down, you basically kind of break even to lose a little bit. If you rent it out, if you buy it with cash and rent it out, you'll return about 5.5% a year. If you borrow money, remember at 3%, your cap rate's 5, plus you get that 4.53% price appreciation, you can actually elevate that rate of return to about 9.5% a year. So if you're doing rental property, you definitely want to put mortgages on it. So the question earlier was, is a mortgage a liability? My answer to that is absolutely, unequivocally not. A mortgage is an asset. All right, Eddie hates the stock market. You know why? Because you got Trump, you got Biden, you got coronavirus, you got recessions. And so the stock market, unfortunately, is very volatile. And that's what breeds these behavioral biases that lead to that behavioral gap that Teresa was talking about. But even though it's volatile, and hey, one year in '84, it was up 55%. This is trailing 12-month returns. And then in 2008, it was down 40%. Earlier last year, it was down 38%. End of the year, up 20%, or 18, depending on what you're doing. But over a long period of time, it smooths out to be a pretty good rate of return. So over the trailing 3 years, about 13%, 5 years, 10%, 10 years, 14, 25 years, 11. If you go back to 1929 and you do price return plus dividends, it's really about an 11% stream. So high rates of return, unfortunately, high volatility, and without advisors, typically high levels of error. All right, Edie loves entrepreneurs, right? And has had great success with her own business. So why not fund other businesses, right? You don't have to deal with the stock market. You can just deal with your neighbor next door who's got a good idea. Well, it's hard to figure out what the expected rate of return is on angel deals. But in the research that I did, there were 2 studies of a bunch of angel deals that came back with pretty similar results, okay? So here are the results. So there was a pool of angel investments, lots of them in there, over 5 years that did generate a positive rate of return, pretty high, 22% IRR, which was pretty great, right? But the median investment in the pool actually produced a loss. And only 10% of the exits within the pool generated cash, 85% of the cash, I should say. So you basically got a 1 in 10 chance of investing in something that's going to produce a rate of return. So if you're going to be an angel investor, how do you increase your probability of success? Well, one, you do a whole lot of due diligence. And we have these conversations all the time. It goes back to judging the management team. What are they capable of? Will they get along for the next decade, et cetera? There's a lot of work that goes into assessing whether an angel deal is worth doing. Also, having done some in the past, those that are within your spheres of expertise, you probably do better due diligence on and improve the probability of a positive outcome. You know, I don't know anything about restaurants. I shouldn't do a restaurant deal. I know a lot about financial services firms. I've done one there that was successful. You know, operating within your spheres of expertise is important. Active participation. The other deal is if you're going to put capital to work and you've been successful, and Edie's capable of generating a 17% IRR in her own business, she could probably contribute a lot of value by participating in that business. Most angel investors who do get engaged increase their probability of success. Now, here's the other issue that most people don't really factor in. If you're going to do angel deals, you need to diversify just like you do with a stock portfolio. And so a minimum of 10 deals, optimally 20 or more deals. So let's go back to Edie and apply this to her experience. All right, this is how she makes money in angel deals. First of all, if you do the math of the 10 deals that she does at $20,000 a piece, if she allocates equally, which is what you should do, you know, 5 of those deals are going to be jackasses and return nothing. 3 of those deals will return half the cash that she put in, right? So those are mules, maybe. One might return 3.5 times what she put in. That would be a racehorse. And then what drives all the returns in doing angel deals is unicorn deals. So she's got to have one in the portfolio that returns 20x, right? So of the 200, she puts 20 grand in there, $400,000 comes back, and that basically compensates her for the loss on those 5 deals and then the 50% loss on those other 3. So to make money as an angel, you better find a unicorn. All right, Edie loves cash. Entrepreneurs love cash, and I'm getting ready to blow your mind. And so if I've got bankers on the call, I apologize for revealing this truth. All right, the bank loves your cash a whole lot more than you do. Remember, based upon the way that the Federal Reserve governs the system, banks can lever up deposits 10 to 1, right? Now, they don't usually do that. They only lever money markets about 5 to 1, and then they invest the remaining balance into treasuries. I'll make this simpler. So her deposit in the bank is 750 grand. The current interest rate in the bank is about 0.1% right now, because remember the Fed has taken rates to 0. So she's going to make off her $750,000 about $750 a year. That's what's in it for Edie. Now, here's what's in it for the bank. The bank can lend $3.75 million. They lend it at prime, which is 3.25. So they earn annual interest income of about $122,000. And then they take the remainder, invest in treasuries, and treasuries aren't yielding much, 0.14, but that's a whole lot more than the 0.1 that they're paying. And so the annual interest income, because it's been levered up so much, is $5,250. So off of her 750 grand, she gets $750. The bank gets $127,000. So that's why when you call your bank, they say, oh, put it in the savings account. Or, hey, here's some Predators tickets. Thanks so much for being a customer, because it's amazingly accretive because they use leverage, and she's afraid to, for the bank's balance sheet. All right, so now let's go back and apply these rates of return that we calculated. On her company, she can earn 16.6%. Remember, we walked through that. Her primary real estate, remember, she borrowed $1.2 million and put down 300,000. And so that generates a negative 0.2 rate of return over the 10-year hold. Her previous property, she is renting out at that 5% cap rate. She's getting a 5.5% rate of return there. In terms of the cash, as I just demonstrated, the bank's making a lot. She is not. In terms of the stocks will return. I'm picking on that, 25-year average. I'm pulling it down just 1% for paying an advisor or whatever. So call that 10.5%. In terms of her angel deals, I'm being somewhat generous and saying that she'll get half of her capital back. And then in terms of bonds, the long-term rate of return on bonds is 2.9%. I think they're kind of mortally wounded right here, but that's a rate of return that we'll use to estimate over the next 10 years what she can achieve. So her overall rate of return on her balance sheet, including her business, is about 8.9%. Not bad, a good rate of return over the next 10 years. Question is, can we improve upon it? All right, that's her current balance sheet, which I just walked through. This is what I would do if she just said, David, put me on the dot, which, as Teresa said, not everybody's willing to do, but I would advocate for this. So in terms of, we're on the right side of the screen here, and just bear with me, I'm gonna do the math. So Eddie company, it's $1 million value, nothing we can really do there other than her focus entirely on that business, stop worrying about all this other stuff, delegate effectively to W&A or somebody like that. So that's $1 million on the balance sheet, wouldn't change anything there. In terms of the primary real estate, I think you leave the mortgage there as it is, don't change anything there. Previous real estate, you suck all of the available cash out of that. So tack on $600,000 in debt to that rental house, take the proceeds of that and push it back towards that stock market allocation. That would contribute, therefore, $150,000 to net worth. In terms of cash, remember she had $750,000. What I would do with that was I'd say, okay, you do need an emergency fund. It does make you feel comfortable in case the roof, leaks, you can instantly stroke a check. So let's leave $100,000 in cash. Let's take the remainder, take $100,000 and put it into a taxable bond account. So you can improve your yield from, call it 0.1 to, I think we're yielding about 3 in our model right now. Get a higher rate of carry on that. And then take the remainder of the bonds that were in the 401k and throw those in stocks. And so we've taken the stock market proportion now from 250,000 up to $1.5 million, okay? Which may make her uncomfortable, but again, she said, I'm gonna be on the dot. I'm gonna trust you to do what you can. So the total net worth hasn't changed, right? We've got 3.4 million in total net worth. What we've done is we've levered the balance sheet a little bit to where we have 5.2 million in total assets at work rather than just 4.6 in total assets at work. And we're financing it at less than 3% in terms of those mortgages. So by doing that, same rates of return, we just changed the mix in terms of the size of each one of those asset categories. We've jacked up her expected rate of return over the 10-year period by doing this to 11.2%. How much is that? Let's walk through it. So her status quo balance sheet, net worth 3.4 million. Her optimized balance sheet, net worth 3.4 million. What's different is the allocation to each asset class. As we demonstrated, the rate of return status quo, 8.9%. The rate of return optimized, now 11.2%. Net worth in 10 years jumps from 8 million at the end of the period to 10 million at the end of the period, which is a gain of $2 million. So just by tweaking the balance sheet, we can improve her net worth position 10 years from now by 25% or $2 million. So it matters a lot. Here's the bottom line. Listen to your advisors. This is not a pitch for W&A specifically, although we're really good at this. It's a pitch for having really competent financial advisors who see the whole balance sheet. Don't just try and sell you products, but really think about your net worth rather than just the assets that they manage. Track your business returns like an investment. I know some people that have been grinding as entrepreneurs for a long period of time, but the value of the business really hasn't grown. If that's the case, then maybe they should consider allocating their time and energies somewhere else. And so you really do need to track your business returns like an investment to know whether you're getting a return on your capital, but also on your effort. Mortgage or real estate, going back to answering that question, especially right now, if you can borrow money at 3%, do it all day long. Invest in, but do not trade the stock market. Now, it's been a crazy day in the stock market today. I think GameStop, which has no fundamental value, was up 50%. Then it went down. It was up 50% last week. Is there bubble activity in the stock market? Absolutely, right? Which is why you have to be selective about where you make investments. I see a lot of opportunity in the investment market today, just like I saw in 2000, but that doesn't mean that certain areas of the market aren't overvalued and due for correction. I think they are, but other areas of the market that have been totally forgotten about are primed for pretty good runs over the next 5 years or so. So you do need to be strategic about exposure to the stock market, but it's not a market where you want to go trade willy-nilly off of your neighbor's advice. Limit low yielding cash holdings. I mean, I hate the idea of spending a bunch of money on bankers who are returning really nothing. It's not their fault, it's the Fed's fault. But if you've got a big bunch of money sitting in cash, find a way to improve the yield on that. And you can use higher yielding bond funds as cash equivalents. Even if you go from 0 to 1%, it ends up being a dramatic improvement. If you're going to do deals, only do unicorn deals, software deals or something where you can get a visibility to a 20x return. I mean, we need furniture shops and stuff like that and bagel shops, but it's hard to figure out how you get a 20x return on those things. So just go into those deals eyes wide open, knowing that really only 10% of those are going to return much. And you really need those returns to be quite large. So only do unicorn deals if you're going to do angel work, and then maintain liquidity to take advantage of crises and opportunities. One of the dimensions that we work hard with on entrepreneurs is trying to get them to understand how important liquidity is, how to have liquidity that's employed and contributing, but also accessible if that pitches unicorn deals or big downturns in the market like we had at the end of March are on offer, so you can take advantage of them. So the bottom line is this. I think most people do an excellent job on the job or enhancing the value of the business that they're in. I think most people do a poor job at balance sheet construction outside of the business, a poor job of really thinking through liquidity, a poor job at striking at other opportunities. And with proper guidance and training, I think people can get a whole lot richer if they can figure out how to manage their balance sheets besides and outside of their vocation. So that is my prepared remarks, and happy to take any questions.
All right, everyone go ahead and post it in the chat. So we have one from Brandon. He says, what sectors are forecasted to make a run over the next 3 to 5 years based on your own DD and personal interests?
Okay, so investor capital, and we'll have a presentation on this coming up, and I locked myself away in a hotel room all last week to figure it out. But where the opportunity is now, you got to be a student of history. Go back to, as I said, 99 and 2000. There's definitely some silly stuff in the stock market right now. I wouldn't chase momentum here. It may work, and you might find some tech names that, like Tesla, go up another 700% this year, but the odds are somewhat against it. The allocations that we're making are down the cap spectrum, smaller cap stuff, tilted towards value, which has been totally forgotten about for the last decade. International stocks and emerging market stocks have been left for dead as well. So I think we will see a reprisal of what we saw between, call it 2000 and 2005, where the S&P 500 and the large cap tech stocks sort of just crabbed sideways, and all those forgotten about areas of the market advanced pretty quickly, significantly, and with great duration. And I'm looking a lot at the US dollar, and the US dollar has rolled over. The current administration is projected to spend 8.8 trillion, or at least those are the expenses they put on the table. If they do that, then you get a bigger deficit, which doesn't scare me per se, but it does suggest that you'll have a weaker dollar. So I think you make more money offshore. I think you make more money down the cap spectrum, and I think you make more money in value style strategies in sectors like financials and industrials and materials than you will on, Facebook over the next 5 years.
All right, we got a couple more questions that came in. Molly wants to know, it says, wondering at what point you should start implementing some of these levers. We are very early in the journey and don't have much net worth, so my husband seems to think there's no point in investing.
That's wrong. So the first stop is making sure you've got an emergency account. So you've got to have enough in savings to sort of cover 6 months worth of spend. I think that's mission critical. Second, if you're working or your husband's working, you've got access to a 401k. Load that 401k with all the savings you can possibly muster and put it all in stocks, and don't worry about it, right? But likely your employer is matching, so you can get free money by doing that. And I think depending on where you are in the cycle, the time to start is absolutely right now. And the younger you are, and I used to be young, but the younger you are, the more impactful the compounding becomes, right? So if you're 25 years old and you've got 25 grand and that stuff stays invested, the compounding is massive. If you're 60 years old and you got 25 grand invested, the 5 years before retirement isn't going to generate enough return to really move the needle. So I would argue for having enough cash in case of an emergency, loading up the 401k, putting it all in stocks, and then, open your statements 10 years from now.
Okay.
Molly, I was itching to jump in here. Molly, if one visual that you can show him is Google a chart that shows the difference between money invested from age 25 to 35. And actually, Leah, if you want to put it in contact, I will send you the chart. But money invested through the ages between 25 and 35, you can stop investing and compare it to someone who starts investing at age 40 through retirement. And the young investor ends up with a higher net worth. So early investing really pays off. And there's a lot of visuals out there to help you in your quest.
All righty. The next question we got, they're pouring in. Are you seeing traditional value plays in this market, or are they just less overpriced? P.S. I'm 61, so a huge pullback might be non-recoverable.
No, I see the value plays. And I will also state this, you have to, at this point in the cycle, without getting too wonky, recognize what's driving the market. What's driving the market is that the government is going to spend $8 trillion. It's a $20 trillion economy. So that's a 50% stimulus, right? And even if they only get half of that, that's a 30% stimulus. So it's the most money the government spent since World War II, right? And by the way, the 50s were awesome in the stock market. Number two, the Fed has increased the money supply by 25% year over year. They've never done that before. So you've got the two biggest forces in the market, the federal government spending money like crazy and the Fed printing money like crazy. Now it sounds scary and it may be down the road and we'll sort that out. But for the moment, what it means is there's just a lot of money pouring into the system, right? And it goes into consumers' hands. Consumers have saved an extra $1.4 trillion since the pandemic began because of all the stimulus. That's going to get spent. Corporations have tons of cash because they've issued low rate bonds and that cash is going to go to work. So you're right. You know, the overall stock market is valued at 24 times forward earnings, which seems high. My point is though, the market doesn't go down just because it has a high PE. It needs a reason to go down. It needs a recession. It needs some sort of big inflation scare. So in the absence of that, there's just going to be a lot of money made. And businesses originations are going through the roof. You know, I think the pandemic, while it was awful, also ended up being like a forest fire that was necessary to take out some parts of each company that were sort of stale or fragile. And now we've got stronger, leaner, meaner businesses that are going to generate higher profit margins that are innovating like we are. I mean, traditionally, I'd have been in a car and I'd be in Nashville and I'd be doing this in a room, right? So Zoom has increased the productivity in our firm tremendously. So I'm very bullish on corporate earnings. I'm very bullish on revenues. I'm very bullish on the return of, you know, the lockdown sort of restrictions boosting what's going on in Europe. You know, China leapfrogged ahead of us in this whole deal. Pretty bullish on that. So I think things continue to melt higher until we hit some sort of wall. The indicator I will look at and do every day is inflation, and I'm not seeing it yet. So I don't think we're at the end of this road yet. I do think, like I said, within the market, you need to look for pockets of value, and that's where we're going, which is small caps, value sectors, emerging markets, and some internationals.
All right, next question says, tell us about Waddell Associates. How are you different from wealth or asset management companies? Are you just advisors? If so, how are you different from others? Also, how are you different from advisors from Schwab, et cetera?
So on staff, we have lawyers. On staff, we have CPAs. And I said this on a meeting this morning. Teresa, nod your head if this is true. I said the most important people in our company over the next 5 years are not the investment committee people. They're the advisors with tax backgrounds. It's the CPAs that are going to be strategic over the next 5 years that are most important people. So we give significant and specialized advice on taxes, on legal constructs. Teresa, you were on a big estate planning call this morning, I know. So in my world, I don't see a lot of firms that talk about the entire balance sheet and tax strategy the way that we do. I see a lot of firms that talk about investments, and they may be really good at them, but if they're just gross of tax investments and they're in a vacuum, they may not really be what you need. So to me, the quality of these firms is really differentiated by the quality of the staff and their regulatory track record. You know, have they been sued? Have they been to arbitration? Proud to say we have not. You know, what does the client base look like? We've got, you know, nearly 1,000 clients all over the United States of America, and we work hard on their balance sheet issues. Ultimately, we get paid to manage assets, but we talk about everything. Right. So the balance sheet could be $100 million and we could manage 500,000 and we'd talk about the 100 million, even though we get paid only on the 500,000. So love to talk to you more specifically about the firm. Contact me, contact Teresa. But I'm super proud of the people that work here, the quality of the advice that we give, and the fact that we do it without constraints. Right. Teresa, did I hit everything?
Yes, the only thing I would add is that we are fiduciary advisors and we're allowed to give advice. Many other firms out there, their compliance and legal departments really restrict them to put put a silo around the investment portfolios, and they're not really allowed to give advice on other parts of the balance sheet. And at W&A, we have made business decisions that allow us to do that. And we're very proud to stand in that very confident role and act more, like physicians would rather than salesmen, do no harm. We're really looking at the entire family and the entire balance sheet.
All right, so we have time for one more question. There's still some in the queue. I'm just going to send those to you guys afterwards, if that's okay.
Sure.
So Aaron says, if you had that 200,000 in the bank and like Edie are comfortable sleeping on a cash pillow or at a minimum prefer to access those funds without penalty, where would you put it? ETF, mutual fund, or something else?
So I'm getting this call a lot, as are a lot of shops like ours, and it's the right call because people realize they're really getting zero in their checking account. So you've got, the stock market out here, right? So that 200,000 out here is going to bounce around like this. And by the way, February during the first term of an administration is typically a lousy month, et cetera. So market's been great. At some point, it's going to pull back. The last thing you want to do is take your 200 grand, dump it in the market, and then get mad at me for telling you to do that. So if you're really averse to being in the market, then the best thing to do is just step out of that ultra high liquidity overnight sort of 0.1% rate. And to me, move it into a suite of, we use active mutual bond funds right now and we've got about 5 of them. So we'd allocate $40,000 to each of them, and they've got wide open playbooks and they're trying to generate positive carry. And like I said, somewhere in the 3% sort of range is about all I think you can get from the bond market for quite a while. So at least, even if that's wrong and it ends up being a 1% carry for some reason, you've improved your position by 10x from 0.1. So I think you take that money, decide what you need to be ultra liquid that you need for a leaky roof, and then you migrate the balance. If you don't want to go into the stock market, into a suite of bond mutual funds with an open mandate where the managers are just pursuing that positive carry. So if you can go from 0.1 to 1, 2 to 3%, you've improved upon that position a lot. So that's what we're doing.
Great. Okay. Well, I want to give a huge thank you to David and Teresa for joining us today. We love having y'all as a huge learning opportunity. And obviously as people, we love you guys. Thank you all for attending today. There will be a recap sent out afterwards with key takeaways, resources, and a recording from today. If you're anything like me, that was a lot of information to take in at once. I'm probably going to go back and watch it once or twice. If you like what you see, hop onto petracoach.com, look under our resources tab for upcoming workshops and webinars. We have them on various topics to help your business and your team scale. Again, David and Teresa, thank you so much.
It was fun. Thank you.
Have a great day, guys.